So how does RBS stack up against other UK banks this earnings season? RBS was expected to post a net loss of £14.4 million. Final figure came in at $528 million. That's more than 30 times what analysts were estimating. And we heard from Lloyds yesterday. Investors didn't like what they got from Britain's biggest mortgage lender. The stock dropped the most in almost a year. That's after Lloyds set aside £3.2 billion to compensate customers who were sold loan insurance improperly. And looking at SocGen, quarterly profit there fell 14% from a year earlier as upheaval in parts of Africa dented their earnings. Profit from international banking fell 61%, as you'd expect. They did pretty well at home, though. So overall, not a great show from Europe's banks. Is it wiser to steer clear of their stocks? I want to ask a man with more than 30 years investment experience in all this. Colin McLean, CEO of SVM Asset Management. The firm specialises in UK, European and global equities and handles funds worth about $1 billion. Joins me now from Edinburgh. I want to get your take on RBS results and particularly how RBS stacked up to its UK peers, competitors.
I think it would draw quite a distinction between Lloyds Bank's position and Royal Bank. I think Lloyds is firmly in the regulatory target in terms of breaking up some of its business, had a much worse PPI position, and overall I think it's in a different position than Royal. Royal is a good core Tier 1 ratio, so in terms of actual capital it's quite well financed. And underlying in these numbers, I think the insurance division, global markets division, I think was quite encouraging. So I think the market will give Royal Bank the benefit of the doubt, really, that they are still turning around.
Yeah, I mean, that seems to be the case this morning, doesn't it? Because their shares are rising. But there's one thing that struck me from looking at these results I wanted to ask you about. They were the only bank, RBS, to turn to the government's asset protection scheme to limit their losses from these so-called toxic assets. And they paid a £469 million APS charge in the quarter. And they're also paying a £700 million annual fee to the government for using this programme. I mean, this is pretty costly for them. Is it worth it?
I think it was necessary. Yes, it has been costly, but I think it was necessary. And even the banks that have not, participated in that, I don't think are necessarily in a better position today, because there's still regulatory moves in terms of separating out bank activities and probably further increasing core Tier 1 capital requirements. So I think there's still plenty of challenges for the other banks, and I think Royal has bought itself a window of opportunity, really, with this. So it's expensive, but I think it was necessary for it. Now,
you're underweight in banks across your portfolios, right? You planning on staying that way?
Yes, we are. And it's interesting that bank shares overall rallied very sharply in March 2009 over the next few months. But in fact, on a relative basis, relative to the market averages, they've given up a lot of those gains. Banks like Lloyds, and for that matter, HSBC and some others, are hitting two-year relative lows to the market. So investors are quietly stepping back from banks and realising that there will be more opportunities with capital raisings to buy stock later on.
OK, now, Colin, I have to ask you about developments elsewhere in the markets, particularly commodities. Some pretty remarkable movements we've seen over the past 24 hours or so. I mean, crude rising, 18% since the protests began in Libya, but tumbling 12% in the first 4 days of this week. Why this sell-off?
I think some of these markets, oil and certainly silver, had got quite overheated and quite a long way from their moving averages, so they were overbought. And I think the margin requirements have seen some of the carry trade also unwind. We're seeing that with the yen move as well. I expect them to resume their progress. I don't think it's broken down the rather longer term upward trend, and I'm quite encouraged by the way in which gold has held up relatively well also. So I think it's a reasonably good move in the context of burning off some shorter-term speculation.
Yeah, gold definitely seems to be clawing back some ground, but we saw raw materials companies, shares in energy companies fall in US trade just yesterday. Just to be clear about this, you don't think this is the start of a significant correction or a sustained bear market as such? You think it's a temporary blip?
I think it's temporary, but I would draw a distinction between the oil and precious metals, which we like, and I think there's a lot more risk just now in copper possibly in iron ore. But certainly copper, I think fundamentals are breaking down a bit for that as well. And I would view that as possibly a bit more of a fundamental correction. So base metals, I am quite cautious on just now.
Great to get your thoughts. Thanks so much, Colin McLean, CEO of SVM Asset Management.